Despite pumping more oil, Nigeria's earnings from crude have plunged by 43%. Here's why that grim turnaround could destabilize the nation's economy. What just happened? According to the latest quarterly report by Budget Office of the Federation, Nigeria's gross profit from crude oil and gas sales dropped sharply by 43.3% in 2024, falling from 1.09 trillion naira the prior year to about 1.08 trillion naira. This drastic fall came even though the country's crude production rose by 12.6% in 2024 to 442.21 million barrels, or about 1.43 million BPD. In addition, total oil and gas revenue before deductions stood at 15.07 trillion naira in 2024 against a budget target of 19.99 trillion naira, thus falling short by nearly 24.7%. Why this matters. Crude oil still underpins Nigeria's economy. Oil exports and crude sales remain one of Nigeria's major forex earners and budget pillars. A sharp decline in profit from crude means fewer dollars, fewer Naira inflows, and a weaker fiscal base. Mismatch between output and earnings. It's counterintuitive. Production went up, yet profits plunged. That gap raises questions about pricing, cost of production, export quality, theft and vandalism, rising costs, or poor contract terms. Budget and fiscal risk. The government budgeted for much higher oil sector earnings. When projections are missed, the risk is higher borrowing, deficit financing, currency weakens, subsidies become unsustainable. Downward pressure on the Naira and imports. Lower oil revenue means fewer foreign exchange inflows. With a still import-dependent economy, especially for refined fuel, pressure on the Naira may intensify, raising inflation and cost of living. What is driving the sharp drop? Here are some of the key factors behind the earnings decline. Global oil price dynamics. While production rose, crude prices may have softened. Nigeria was budgeted at $77 per barrel. Actual global price may have been lower. Quality and cost issues. Increased output from marginal fields may have lower value. Rising production costs, logistics, theft, and vandalism cut into margins. Export constraints and production shortfalls. Although 442.21 million barrels were produced, average daily output at 1.43 million BPD was still below the 1.78 million BPD benchmark used in 2024. Exchange rate and accounting effects. Some of the previously reported gains were due to Naira depreciation boosting dollar-remitted revenue in Naira terms, not necessarily higher output value. Analysts say the underlying balance is weak. The broader implications for Nigeria. Economic vulnerability. When oil earnings plummet, non-oil sectors must pick up the slack, but Nigeria's non-oil export engine remains weak. The oil export-only model is exposed. Budget, credibility, and borrowing. If the fiscal plan assumed stronger oil revenue, the shortfall may force increased borrowing or cuts to social services, infrastructure, or subsidy payments. Currency and inflation risk. Reduced foreign exchange inflows widen the Naira's vulnerability. Imports become more expensive, inflation may rise, and consumer purchasing power is hit. Incentive for reforms or fiscal panic. A collapse like this could spark serious upstream-downstream reforms, exploration, refining, value addition, or trigger reactive policy, new taxes, subsidy hikes with negative side effects. Investor and market sentiment. When revenues decline amid rising production, investors ask why. Cost of production, theft, infrastructure deficits, and regulatory risks become magnified. What to watch in the coming months? Upstream performance metrics. Are new fields coming on stream? Is production sustainably improving beyond 2024 gains? Oil price trends. How do Brent, WTI fair, and Nigeria's realized price compare with budget benchmarks? Fiscal reforms. Will the government adjust budget targets, revise spending, or seek new revenue sources? Currency movement. Will the Naira stabilize or fall further, and will inflation respond? cost control, and sector integrity? Will theft, vandalism, production disruptions drop further? Some reports show crude losses at 16-year lows. Diversification progress. Are efforts to boost non-oil exports bearing fruit? Are refining, local value addition increasing? Why this is a turning point. The 43% drop in crude-related earnings isn't just a bad headline, it's a structural warning. It shows that more barrels do not guarantee more revenue. It underscores that Nigeria's oil profit model is vulnerable to cost, price, quality, and export logistics issues. It forces a reckoning. Without diversification, improved upstream-downstream value chains, and robust export infrastructure, Nigeria remains at the mercy of global oil swings. Final reflection. Nigeria's strange paradox, rising production, falling earnings, holds a painful lesson. The oil export model is no longer enough. Success will depend on reducing costs, securing production, improving quality, refining locally, and building the whole value chain. For policymakers, the message is clear. High production without high value is risky. For citizens, it means the oil windfall dreams remain fragile. For Nigeria's future, the challenge is to convert black gold into sustained economic gold, not just barrels, but value. Unless the nation acts fast, the 43% plunge may become the starting point of deeper fiscal and economic trouble, not just a one-off dip. The time for structural change is urgent.
Thanks for watching. If you enjoyed this update and want to stay informed with fast, reliable news, don't forget to subscribe to Newsflash 360. Hit the notification bell so you never miss a story. Your next headline is just seconds away.